Hey, what's good, YouTube? This is Chris Hendricks. Today, I'll be basically showing you guys how I did my entries. Because people have been commenting, talking about, please show us the specific entries. So basically, we'll be focusing on the indices, Nasdaq, US 30, German 30, those top three, and how to get the entries, right? So I'm just gonna erase every single thing. I'm sure you guys have seen how the markets have been this week. They've been crazy, bro. So currently we're gonna focus just on this part, because with indices you can't really go back to the past market and factor that in with your current entries. You will you'll learn the hard way. So what we're gonna do first is obviously figure out our lows, our highs, and the mid highs as well. So that's the first thing that I do. So now you know where the market is playing amongst these levels. Unfortunately, the market didn't get to the highest high for a perfect sell. It just used this nice mid high. So we're gonna scale down to the 15-minute time frame. So as you can see, the price moves into phases, right? An impulse correction, and sometimes the correction can be a reversal correction for a reversal, right? So you can see from this point, the market was impulsive and then it started correcting to this nice level and it sold off, right? So since we're focusing on the entries, you're gonna spot your, what do you call this? Your correction, right? Get your support and your resistance of your correction. And when you see a reversal correction on a level, that should give you confidence that the price is actually reversing and going the opposite direction instead of continuing going up, right? And how do you confirm that? At the very peak of that correction, within the level, your zone, your high, whatever, you must check how the market behaves there, right? So you can see once it touched our zone, it was rejecting, right? Rejecting hard, actually. You can see this first candlestick, huge rejection right there. And if we scale down to the 15-minute time frame, you can actually see it properly. And remember, your correction needs to have at least 3 touches, third touch being the highest probability. And this is the third touch. And why do I consider these 2 touches as one? Because when you actually draw out the correction, this is basically it, right? So first peak, second peak, third peak. So that is why I don't count these as like individual touches. I just consider it as one, so it shouldn't confuse me, because the key is to keep things simple. You can't use a million strategies, a million like information, data. You'll get confused. So the best thing is to keep it very simple, very clean, and take it from there. So with this correction, reversal correction, if you wanted to enter at the very peak of it, like right there to a sell, what you would have considered is how the price is behaving at the third touch, because you know third touch has the highest probability in your correction. So what you would want to see obviously is the price rejecting, showing loss of momentum to the upside in the case of a sell, which was confirmed by these rejection, these wicks or pins. That was the first confirmation that the price is losing momentum, and it's very likely to turn and reverse at the third touch, which is obviously this point right here. So that's the first thing that you would want to see. And then second thing is you want to see reversal candlesticks. So you don't really need to know all the different names, doji or Morningstar. You don't really need, because if you try your best to memorize all those names, all those candlesticks, you get confused. You will start seeing false reversal candlestick. You consider this as a reversal candlestick, like so many, right? So the key is to look at the very level of the third touch, which is within this range. That's where you would only want to see your reversal candlesticks. It doesn't matter what name it is. All you have to know is the shape of the candlestick. So basically, when a candlestick is enlarged, just like this last bullish candlestick, you know the price has a lot of momentum, right? So you wouldn't enter at the close of this one because you don't have enough information of the price selling or reversing, because the last bullish candlestick was huge. It showed a lot of momentum. And as you can see, if I zoom in, it did not have a wick at the bottom or the opening of it, which means momentum to the upside. So you would have waited, because patience is key. I won't lie to you. You need to have patience. So you observe the market, look at the following candlestick that's going to form. And what did we have? We had this nice bearish candlestick, which shows that the bullish candlesticks are losing momentum. And you can see this huge wick on the downside. It shows that the price had momentum, but then obviously it rejected back up, and it went up, rejected again. So the price was still trying to decide, like, are we actually going to the downside? Are we gonna continue going up? So you just wait. You wait. The key thing is to be patient and observe. So look at what happened with the next candlestick. Huge candlestick to the downside. Huge. Shows so much momentum. It even engulfed so many previous bullish candlesticks. They all fit within this one huge candlestick. So now you have this huge candlestick confirming that there's momentum to the downside. And then the previous bearish candlestick shows that, fine, we are just starting off. We still need to decide. People are still not sure whether to execute for buys or sells. There's still like an imbalance right there. Very indecisive. So, but then it's still regarded as important because this is a reversal candlestick, right? As you can see, it's smaller than the previous candlestick, which was a bullish one. And the key thing is that it's bearish right after touching our horizontal ray right there, our mid-high. Our mid-high, because you can adjust it and touch the previous price, but then you can see it's going to engulf a lot of price right there. So for reasons of keeping the charts clean, you just reduce the size of it so you can see everything clearly. Okay, let's zoom back to our price. So now you have, okay, let's just go to the 5-minute time frame and see what we had going on. So you can see how the price go to the third touch. Now it got there by this nice correction within the main correction. And the thing is, with this correction, you can also draw your trend lines. Obviously, we don't need to draw a trend line at the top because we already have this main trend line. But look at this, very interesting. We have 1, 2, 3 touches. Third touch, highest probability. Just like the main correction in the bigger time frame. Let me erase that. And same story. So the reason why you need to always wait for candlesticks to form to give you confirmation, just look at this one. This last bullish candlestick right here, it formed. It was smaller, which showed a loss of momentum. And then the next candlestick was bearish. It was a selling candlestick. So some people would have taken this as the sole confirmation to go down, and they would have executed right there for a sell at the close of it. But you can see the next candlesticks formed, and price went, it was pushed up because they didn't wait for the second settling candlestick. So you need to wait for at least 2 or 3 selling candlesticks to form at your third touch of your correction for you to have like complete confirmation. So we would have ignored this selling candlestick because of this bullish candlestick that formed. Okay, now we wait. This one forms. Okay, now we're back. Our interests are high again. And then we wait for the next one. It's a selling candlestick. But since this is a 5-minute time frame, 2 candlesticks are not really enough. You're better off waiting for 3 candlesticks in the very lowest time frame. But then in higher time frames like 15 minutes, 30 minutes, an hour, 2 candlesticks are enough. So in this case, we had 1, 2, 3. And at the opening of the 4th candlestick, we execute. So we execute at the opening of this one. And then, unfortunately, we have to set our stop loss at the highest peak of the third touch, which is that point. Let me just remove the circle. So it's right above this week, which is the highest point. So it's not much of a loss if you scale properly, but you can see the drop compared to the stop loss. Risk reward ratio is massive. And then you set your first take profit at the next low, which was this one. As you can see, we slightly broke and then went back inside. So that is where we would have taken our positions and took the bag home, basically. So that's how you would have entered with that kind of setup. And then the price decided to fall, and then we had this sell. I think it was during the New York session, 3 p.m. When was it? I think yesterday or the day before yesterday. Forgot really. And we had, since we now have this new low, if you are the type to enter, what do you call this, these opening sessions, you would have entered the sell and then set your stop loss right there. I mean, your take profit right there. But I am not within, those kind of trades are not within my competence, basically. But then the price recovered, right? Recovered, went back to this. It's basically an imbalance, because if you can see the previous low, you can see now we have the price respecting this imbalance, previous low retesting on it, and then that's where our interest picks back up. So we scale and see what we have. So you can see the first candlestick that touched was this first week. Very, very long wick, shows a lot of rejection to the downside, but that's not where we execute. Remember, we have to wait for at least 2 selling candlesticks in the case of a sell, right after our rejection at our key point, which is now this horizontal line or this resistance at this nice imbalance, right? So you can see right after this nice wick, the next candlestick was a selling candlestick. We would have ignored it because of this bullish candlestick. It kind of invalidated this selling candlestick. So wait for next candlesticks to form. It was a selling candlestick, and then we wait for the next one because we need at least 2. You can see the next one was bullish, so we wouldn't have entered. Still, next one is bullish. So if you had entered at the close of this one, you can see now you're suffering losses. And if you have your stake, what do you call this, your take profit, your stop loss very tight, you would have been taken out. So cool, we wait for the market to play out and give us at least 2 selling candlesticks. So this was our first selling candlestick, and then followed by another selling candlestick. And as you can see, the second candlestick has no wick on top, which shows a lot of momentum, right, to the downside. So with that information alone, now we have the confidence to execute. We can actually start placing our positions at the next opening, which was this candlestick right there. Set your stop loss right above the highest peak, which is that point. As you can see, the price never went back to our stop loss. It just went, it sold off, and unfortunately I did not catch this. Oh my god. So it's basically similar to this sell that I explained. The movement is almost similar, but this one is a bit more. So when it comes to your take profit, obviously you set it with the previous lows, this was the next previous low. So as you can see, we reached take profit, and the price just slightly went below it, but it's cool. We would have been happy with that almost 1% movement. So that is how you would execute your entries. So let's move on to the next pair. So I'm just going to explain. This one is very quick, nothing fancy, nothing hectic. It's just based on an impulse behavior, right? So we're gonna kick it off from the 15-minute time frames. So if we draw what do you call this, horizontal ray right there, you can see Nice double top. You can also just use this one as well, but just for more accuracy, you can just use this instead, but it's the same thing, really. Doesn't matter. Or you can use all three of them and then use the 1 to 3 formula, basically, right? Because you know third touch always has the highest probability. So you focus on the third touch. But if you are not considering this as a touch or this as a touch and you just want to do this, a double top is very valid, just like a double bottom. They're both valid, right? So let's just keep it to a double top, but I'm gonna reduce my area so that it can be clean. So main thing, price went up impulsively and then started correcting to our key area. So remember, we have two kinds of corrections. We have, say we had an impulse followed by a correction which is relatively flat. That signals more of a continuation. And then we have the second kind of correction where we would have an impulse and then the price would start correcting, but in an ascending manner or ascending channel, whatever you want to call it, or structure. And then you'd, as you can see, when you draw your, this is ugly, boy. But if, okay, I can't, but it's fine. So you can see this one is more vertical than horizontal compared to the continuation correction. And when it also does this on its way to a key level, you know it's a reversal. It's clearly a reversal, right? Okay, cool. With that said, we move in and what you can do is basically just sweep your trend line just like that. Get your support as well. But the key area really is the resistance in this case. So with this one, many can argue that it's more or less like this as well, which is fine, right? And when it comes to that 1, 2, 3 touch formation, you can see we also still have 3 touches on this trend line. First one, second one, where you can argue that it's at this point, or you get the idea though. So for a risk entry, well, it's less of a risk, to be honest, because we have so much to confirm before we enter. So we focus on the third touch, which is this area, obviously. Third touch, illustrated by the arrows. So what you would want to see at the third touch is the price starting to behave in, like, for it to reject and just give you huge wicks. And remember, the way the wicks happen matters, because you can't say this wick now signals the price going down because it's a huge wick. It matters where it happens, right? The key, just like reversal candlesticks, right? It matters where it happens, because we have reversal candlesticks all over. As you can see, this point we have 2 reversal candlesticks. Others would say, now we see reversal candlesticks, now the price is going to reverse and go up. No, no, no. And the key thing is where those reversals happen. So I reduced my key level right there. So if I zoom in, you can see where the price touched this week. Very nice. And then the following candlestick was a smaller bullish candlestick, which shows you a loss of momentum. So from that point now, your interest starts to peak and you need to focus on what happens next. You don't execute right at that moment, at that very moment. No, no, no. You need to wait for the next candlesticks to confirm that indeed what you are seeing is valid, right? Because we don't want to jump the gun before the market actually, tells you where it's going. So you need to listen to what the market tells you, and then that's when you follow the market. Because this thing of trying to catch those sniper entries, and it's a huge risk, especially to traders who don't have a lot of capital, say a student or you're working, a low-paying job. You only have that little funds or resources to actually trade once a month. Say you took a huge risk, sniper entries, and then the price just goes in the opposite direction, not in your favor. Now you lost that account in case of those kind of traders who don't factor in risk management. Now you have to wait for that other month now to trade. It's tough, you understand? So it's better to wait for the market to tell you and confirm that it's actually going whatever direction you forecasted, basically. So now after this nice small bullish candlestick, others can regard it as a reversal candlestick, but in my it's not that small, but it is a reversal candlestick because you can see it's way smaller. But this one, you can see if it was this size, it would have been a perfect reversal candlestick. That's why I tell you that the thing of learning all these names of reversal candlesticks, in the textbook, you find they'll say this is a reversal candlestick. It must be this small, but then in reality, you get reversal candlesticks this size, right? That's big. So it'll confuse you a lot. All you need to know is at your key level, when a candlestick is rather small in terms of its body, but then it has wicks both sides, that's a reversal candlestick. That's all you need to. You don't need to know its name or whatever. You just need to know the behavior and the characteristics of it. So right after this candlestick, we had a selling candlestick, right? So that's when now we focus. And the body was not that big. It didn't really show a lot of momentum in terms of its body, but then the wicks says a lot. Because the opening of this thing, it was here. And then it fluctuated up and down. It bought a little, but then when the downside, the wicks at the bottom compared to the wicks at the top, you can see they're bigger. Well, it's singular, so it's bigger, right? Compared to this one. So that shows you a bit of information like, okay, it went down more than it went up. Okay, fine. Let's wait for the next candlestick to confirm this current candlestick. So the next candlestick, you can see it just opened because this was the opening. It didn't even bother going up. It didn't even bother. There's no wick. It didn't even bother. It just sold off, shot down. And it's huge. It's the biggest candlesticks, the past 1, 2, 3, 4, 5, 6, 7 candlesticks. It's the biggest one, the past 7 candlesticks. Right after this selling candlestick. So 2 selling candlesticks in a row. And the second candlestick, it doesn't have a wick at the top showing any kind of buying momentum, right? It just sold off to the downside, which on its own, that should tell you that there's a lot of selling power at this point. There's a lot of momentum to the downside. So what you need to do is, when it closes, it has to close as a selling candlestick, of course. You open your positions at the third candlestick. So this is the third candlestick. This is where you execute, sell, 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 sell. Whether you go, you reserve, or you risk, that's where you enter. Set your stop loss right above the previous high, case of a sell. So it's right there, right above, right? And then you just scale down to the previous low. So you can see price sold off. This is the previous low. Draw level right there. So you can see the price reached our take profit, and then it started, playing around that point. Then that was the first entry. You would have been happy with your results. You minimized your risk, like drastically, bro. You only risked this much, and then this is the reward. You understand? So fine. If you were not done, you can now still look at the market and see what's going on. So obviously, there's a nice double top for continuation to the downside. You would have executed right there, and then obviously set your take profit the next low. See, we reach the next low. And the thing is, with the market, there's these imbalances. When the price pushed back up, it was fixing this imbalance basically, or retesting. So you would have sold right there as well. Don't need to explain all those rules. And then you can see we also had another double top where the price sold off. But since there are no 3 touches on the top, it's just 2, and you were not sure if the price is actually gonna respect this double top to the downside, you still would have used the rules of the candlesticks. So as you can see, the last bullish candlestick was a nice shooting star. It's called the shooting star, morning star, but it doesn't really matter as long as you know it's a reversal candlestick. And then the following candlestick was a bearish candlestick with no wick at the top, which means the moment it opened, it just sold off, right? That was the first selling candlestick. The second candlestick, it did the same. It opened, didn't even bother buying, just a peep, nothing. It just sold off. So at this point, we're in the 5-minute time frame. You had 2 options, whether to wait for the third candlestick to form and close, or execute at the opening of the third candlestick. So let's say you did sell right there, set your stop loss right there, and then you just enjoy the price going down, bro. Very simple. So the key thing is to look at the number of candlesticks that you have and the kind of candlesticks that you have, with obviously the characteristics considered in terms of like the body, the wicks, the length of it, you understand? So that's the key thing when it comes to entries. And once the price broke this support, you would have also taken this retest. It's just simple, bro. So that's how you would have done it. Yeah, I think this is it for today's video. I was just catering to those who were commenting. Please show us how to do entries. We need to know how we can validate our entries. We've seen enough about structures and all kind of things. We need to focus on entries. So this video wraps everything you need to know about entries. It's not that difficult. So first thing is you need to know how the price got to your key level. Key level, I mean, see this horizontal line? When the price gets to it, that's the key level. Because either two things can happen. It can either break and continue buying, or it can reject and sell, right? So you need to know how the price got to your key level. How did it get to this key level? By this nice correction. And what kind of correction is it? A reversal correction. That's the first thing you need to know. And then you need to count the number of touches the correction has. Third touch has the highest probability. Always has the highest probability. You are more likely to win with the third touch over the second touch. This one, right? Because say you would have sold, because let me zoom in and show you what I mean actually. Because you can see we also have this small correction right there. Yeah. Say, okay, fine, this correction broke the support, and those kind of traders who wait for a breakout. Say you waited for your breakout and you sell right there. What happened? The price went back up. It went back up for the third touch. Touch number 3 always has the highest probability. So you must always look out for that. Because this is a good example of the second touch failing. Even though you had a nice correction, down movement, a nice breakout, nice candlesticks, it still went against you. And you must also consider impulses and corrections. So from your third touch, from your entry point, you would want to see a nice impulse, and then followed by a correction, which is this point right here. And you can also maximize your entries by entering at the correction, because it's a continuation correction, impulse, correction, impulse. So you would have entered right there as well. So there's just way too many opportunities, but you must know how to enter. You must know the behavior of the candlesticks, where they matter. They matter at the key levels, your entry points, third touch, usually third touch, in some cases double top, which is basically just 1-2 touches. But the concept of the candlesticks still stays the same. Yeah, that is it for today's video. If you guys reached this point, you are probably one of my most loyal supporters. So I thank you I appreciate you. If you are not subscribed, just make sure you subscribe. Wouldn't take much of your time. Hit the like button, and I'll see you guys on the next video.